So let's start. Hey, Caroline, can you remember the asset retirement obligation we calculated in the last class?
I don't think I have it. I'm sorry.
Okay, so let me just review. Okay, see that here was the problem. And from this problem, we have calculated the asset retirement obligation. And I believe you can remember what is asset retirement obligation. So asset retirement obligation, as we said in the last class, that whenever you are working to create a new asset, so sometimes you need to destroy the old asset. So think about uh, coal mine, especially in case of mining companies. Uh, what they do, say this is a park, okay? This is a park, and you have coal mine in the park. So, okay, so if you want to dig this park for the coal, for the exploration of coal, so the city or the state may require you to restore this place in a park in future, okay, after completing the coal mining. Can you see that? So it means that you have a future expense to restore this place, okay? So this is actually called the restoration expense, and sometimes it's called asset retirement obligation, okay? So let's see this example again. So the Jackson Mining Company paid 1 million for the right to explore a coal deposit on 500 acres of land in Pennsylvania. Cost of exploring for the coal deposit total 800,000, and intangible development cost incurred in digging and erecting the mine shaft were 500,000. In addition, Jackson purchased new excavation equipment for the project at a cost of 600,000. After the coal is removed from the site, the equipment will be sold. Okay, and the second part is saying Jackson is required by its contract to restore, so that to restore the land to a condition for recreational use after it extracts the coal. So the company has provided the following three cash flow possibilities for the restoration cost to be paid in 3 years after extraction is completed. And they are possibility A, B, and C, and their probability is C, 30, 50, and 20%. So say that sum of these three would be 100%. Okay, and the company's risk-free credit-adjusted interest rate is 8%. So we need to calculate the, meaning we need to multiply the probability by the present value factor. Okay, so this is 30%, 50%, and 20% probability. So this is the actual amount after multiplying with the probability. So this is the total amount 590. So multiplied by the present value factor. Okay. So this is the present value right now. So the total cost of the coal deposit would be this one. See, this is the purchase right, exploration cost, development cost, and this is the restoration cost. So sum of all these would be our total cost of the coal deposit. See that, and the journal entry would be, so this one is our asset, total asset. So the name of the asset is coal mine, correct? So the coal mine debit, and we paid some cash. Okay, this amount in cash we have paid, and this is a actually a future liability. Okay, and we are calling this one as asset retirement liability. So yes, so this is the journal entry, initial journal entry. Okay, and we have purchased an equipment, that is excavation equipment. So the equipment is as usual debit and cash credit. And see that this was our present value of the future asset retirement obligation. So after calculating this one, so every year we are calculating the interest. Okay, meaning this is an expense, the accretion expense. So this one, okay, multiplied by 10%, 8%. So this is our actual accretion expense for the first year. Okay, and the asset retirement obligation will be increased by this amount. So sum of these two would be equal to this one. Okay, again for second year, 8% of this amount, this, and we will add this amount with this, and we will get this one. And for the third year, 8% of this amount, so it would be this one. Okay, so accretion expense balance will be increased by this one. Okay, so sum of this one plus this one would be this one. This is how we calculate the accretion expense. Okay, and every year after calculating the accretion expense, we will uh, prepare a journal entry, and it is accretion expense debit and asset retirement liability credit, because you know that accretion expense debit, because one expense is increasing, so that is why it's debit, and the asset retirement liability is increasing, so that is why it is credit. Okay, and think that at the end of the third year, so when we are restoring the place, meaning the land, so if our actual expenditure is more than the asset retirement obligation or more than the restoration cost we have already calculated, okay? So then, so mean actually we have initially thought that this would be our expense, okay? But actually this is our expense. So the difference between these two would be recorded as a loss. See that? So asset retirement liability debit, loss is debit, and cash would be credit. So please have that in mind. Okay. So this is very logical. Actually, we thought that our expenditure would be 590,000, but actually the expense was 625,000. So the difference between these two values is our loss. Okay. Okay. Let's try this one. Caroline. Who else we have? Jacob. Oh, we have many. Pranil. Let's try this one. So what is the initial cost of our mine? 3 years. So, and I will ask you to calculate the accretion expense for the first year. Okay. Okay. So we're solving this one. This problem is from the PowerPoint. So number of column 2. Amount. This is the probability, and so it is saying 5 million, and the probability is 40%, correct? So what is the amount? 5%, meaning 40%.
2 million.
2 million?
Mhm.
Okay, so this is 2 million. And 10 million probability is 60%, correct?
Mhm.
6 million?
Correct.
Okay. So total is gonna be 8 million, correct?
Mhm.
So this is our total. Now let me show you. Present value factor. And I equal to 6%, n equal to 3. Okay. In that case, let me show you. I have also added a present value factor table on Learn. You can see the present value factor table. Okay. I'm showing you from the scratch how to. Okay. So this is the present value factor table I have. Let me show you. See that we can see this is the interest rate, okay, and this one is our number of years, okay. So we have number of year 6, no, one number of year 3, and interest rate is 6%, correct? So 6%, you will go this. Okay, this is the column we will be looking for, and number of years 3. Go. Okay. See that. So what is the rate? We can see
0.8396.
0.8396, correct? This is the value we can see. Okay, I'm just copying this one. Let's see. Okay, this is the present value factor we have. Okay, so now, therefore, the present value of asset retirement, present value of registration cost would be, so multiplied by 0.8396, and which is equal to how much?
6,716,960.
Okay, so it should
6 million.
6 million
716,000.
16,000.
960.
Awesome. Okay. So what is the initial cost? So the initial cost of copper mine would be
The 50 million.
cost of copper mine would be see what are the expenses we already so paid 50 million, this one, correct? And then they have also incurred exploration and development cost of 15 million on the project. So 50 million, 15 million, and this one. So total would be, so the total is gonna be 50 million plus 15 million plus 6,716,960, and the total is gonna be 71,716,960. You got it?
Mm-hmm.
Okay, now my question. What is the accretion expense for the first year? For the first year, what would be the accretion expense? Can we do this? Accretion expense for the first year. Pranil, are you with me?
Yes.
Awesome. So what is the accretion expense? So I'm just answering this one. Okay. Answer. See, the accretion expense for first year would be our asset retirement obligation is 6,716,000. This one multiplied by 6%. Say that this is the first year's accretion expense. So what would it be? Let me take an Excel. It would be easy. This one. Okay. Okay, this one. Did you get it? This is our accretion expense for the first year. What is that? 403,017. Or we can say it's 18. 403,018. Okay. So you now know how to calculate the accretion expense. So we have a similar problem over here. See, the asset retirement obligation, it is easy. Okay, it should be easy. So see that we have, say,
I have a question on that last problem.
Sure. Come on.
Yeah, how did you get the how did you get the n equals 3?
Oh, awesome. So n equal to 3, see that, just read this line. It estimates the possible cash flows for restoring the land.
Oh, I see.
3 years after its extraction activities begin. Okay?
Yeah, that makes sense. Thank you.
Okay. Awesome. So now let's work on this. This is almost the same problem, and I'm sure you can do it in a minute. So how? Okay, let me copy this table. It would be easy for me. I'm just copying this one. Go there. See? Awesome. So it is saying 200 million paid for the right. Okay. Then they have spent 60 million on the project already. And these are the, it's also 3 years it is saying. Okay. Possibilities. So what we have, so 10 million. And the probability is 60%. So it's gonna be 6 million and 30 million, probability is 40%, so it's gonna be 12 million. So total is 18 million. This is our total. And now present value factor, it should be I equal to 7% and n equal to, see, it is 3. You can see 3. So the factor would be, let me show you. Okay. So n is 3. So let n is 3 go through this row until 7%. So we can see that it is 0.8163. I'm just copying this one, 0.8163. Okay, that's the 0.8163. Okay, we have this one. So therefore, present value of restoration cost would be equal to 18 million multiplied by 0.8163 is equal to, how much is that? It's gonna be 14,693,400. Okay, so this is the question they have asked. What is the amount of asset retirement obligation? Asset retirement obligation is this one. Okay, this is our asset retirement obligation. Now come, okay, let me make, okay, I'm just making them a different color. So we know that these are the solutions. Okay, these are answers. Okay, come here as accretion expense. So let's see the accretion expense of this one. Accretion expense of this one would be, so let me copy this table. So we need to calculate the, okay, so again, what do we have? They spent 6 million and okay, so say that 5 years and their interest rate is 10%. Okay, so we can solve this one very easily. Actually, we don't need to calculate the total expense for this. What is that? Mineral mine. We just need to calculate. They said the how much accretion expense will the company record in its income statement for the year 2018 fiscal year. Okay, this is the question. So we just need to calculate the asset retirement obligation and the accretion expense. So to do that, let's calculate 300,000, 25%, and the amount is 75,000. Okay, then we have 400,000, 50%, and the amount is 200,000. Okay, then 500,000, 25%, and the amount would be 125,000. So total is gonna be 400,000. Okay, and present value factor. Present value factor when I equal to 10%, n equal to 5. So we can see that it's 5. So the present value factor would be, so see that n equal to 5 and go to the 10%. So 10%, we got here. See, this is the 10%. Okay, copy. So this is our factor, okay? The present value factor it is. So our asset retirement obligation would be equal to 400,000 multiplied by 0.6209. Okay, and which is equal to 248,360. Okay, and now acquisition expense for 2018 would be equal to, acquisition expense would be equal to, say, 18. Let me insert an equation. The first one is very simple. First one, 248,360 multiplied by 10%. Okay, is equal to, it's very simple. So is equal to 24,836. But the problem is, see that on March 1st, 2018, we have started. Okay, so for the fiscal year 2018, we have only 10 months. So this is the acquisition expense for actually 12 months in 2018. Okay, so acquisition expense for the 10 month in 2018. Okay, it should be, let me insert again. It should be, so 24, okay, 24,836, okay, multiplied by, so it should be for 10 months and divided by 12. So the amount is equal to 20,696.67. So which is equivalent to 20,697. Okay, did you get it? Okay, we got it. Any question on this? Anybody? Anybody has any confusion?
No, sir.
Okay, awesome. So this is a problem for practice actually, the cost of equipment and intangible, and this is the lump sum acquisition. I think we got it because we have solved a similar problem in the last class. Okay, and this one we will solve intangibles. Okay, see what we have. In 2018, the Breton Fitness Company made the following cash balances. The exclusive right to manufacture and sell the texture workout machine from Symmetry Corporation for 200,000. Symmetry created the unique design for the machine. So Breton also paid an additional 10,000 in legal and filing fees to attorneys to complete the transactions. An initial fee of 300,000 for a 3-year agreement with silver zinc to use its name for a new facility in the local area. Okay, silver zinc has locations throughout the country, and Bratton is required to pay an additional fees of 5,000 for each month it operates under the silver steel name. Okay, with the payments beginning in March 2018. Bratton also purchased 400,000 of exercise equipment. Then the exclusive right to sell Health Choice, a book authored by Ken Patterson, for 25,000. To prepare a summary journal entry to record the expenditures related to the initial acquisition. Okay, let's see. What do we have? So, hmm, what do we have? Initially we paid 20,000 plus 10,000 for the patent. Okay. Uh, See that this is the exclusive right so to manufacture. So that is why it's a patent. So patent, that is 200,000 plus 10,000. So it is 210. Then we spent another 300,000 for the franchise. 3-year agreement, okay? And franchise. We spent 300,000. Then see that Breton also purchased 400,000 of exercise equipment. So equipment, that is 400,000, and we have also purchased a copyright, exclusive right. This is the copyright for the book. So copyright, that is for 25,000. Okay. Okay. Now cash is gonna be total. So total is 935,000. Okay. And to record all the expenditure related to initial acquisition. Okay, this is what we did. This is not difficult. Now let's see. This is the lump sum. We have already solved one problem, so this one is gonna be for your practice. Okay, so practice this one. Okay, acquisition cost non-interest bearing note. So what is that? I have non-interest bearing note. Actually, there is some difference between the face value and the present value. Okay, and the difference is our profit. So that is why, sorry, it is non-interest bearing, but we have to pay. Okay, and let's see. So if we read the problem first, acquisition cost and non-interest bearing note. Okay, so on January 1st, 2018, the Binder company purchased a used tractor. Okay, the company paid 5,000 down and signed a non-interest bearing note requiring 25,000 to be paid on December 31st, 2020. And the fair value of the tractor is not determinable. An interest rate of 10% properly reflects the time value of money for the type of loan agreement. The company's fiscal year end is December 31st. Okay, now the questions are, prepare the journal entry to record the acquisition of the tractor, round computation to the nearest dollar. Okay. So now what we do, we need to calculate many things. The first one is, let's calculate the present value of, see that they have signed a note, $25,000. Okay. So present value of $25,000 note. Okay. And here the present value factor at n equal to 3, I equal to 10% is, okay. So let's see from the table, n equal to 3, I equal to 10%. Okay. So n equal to 3, I equal to 10%. So what we can see, 0.7513. Okay, I'm just copying this one, 0.7513. Okay. So therefore the present value of the note would be equal to 25,000 multiplied by 0.7513 is equal to, and it's going to be 18,783. Okay. Now see that this is the note. Okay. And we paid 5,000 cash. So let's see the journal entry. So the journal entry would be tractor, and what are the values? We paid 5,000 cash plus, and this is the note we signed, and the present value of the note is only 18,783. Okay, this is the total value of the tractor. So it's gonna be 23,783. Fine. And how much cash we paid? We have paid 5,000 cash. And we have signed a note payable. Okay. And the value of the note payable is 25,000. See, the difference between these two would be our discount on note payable. See that? Discount on note payable. This is the difference actually, right? Difference. Okay. This is the difference between these and this one. We have two credit. So total credit we have 30,000. So the difference between 30,000 and 23,783 is our discount. So this is gonna be 6,217. Okay, we got it. Okay. And requirement 2, and it is saying how much interest expense will the company include in its 2018 and 19 income statement for this note? Okay, that's fine. So what we do for interest expense for 2018 would be the present value of the note is 783 multiplied by 10%. So it's gonna be 1,878, and cash expense for 2019. See that it's gonna be cumulative. So we have the capital 18,783 plus we have already calculated interest of this amount. So we will be paying interest on all of these now. Okay. Okay. So 10% again. So it's gonna be the amount is gonna be 2,066. Requirement 3. What is the amount of liability the company will report in its 2018 and 19 balance sheet? Okay, 2018 balance sheet. So the amount would be 25,000 note less the discount value is, see, we have recorded the discount value 6,217 minus this is the amount of interest we calculated. So we will subtract this amount 1,878. So this is the amount of liability will be recording. So it's gonna be 20,661. And for 2019 balance sheet, so it will be 25,000 less 6,217 minus 1,878 minus the interest of this one. Okay, 2066. Okay, and the amount is going to be 22,727. Okay, this is how we write. Different color for because they are the answers. Okay, so this is the answer to problem number 6. Okay, we have very interesting problem for the interest capitalization. Okay, what is interest capitalization? Interest capitalization means, say, when we are when we create an asset or purchase an asset or build an asset, we take loan. Okay, we take loan, we pay interest on the loan. Okay, so now the question is, should we also include the interest on the loan with the cost of the asset we are building? This is the question. Okay, so the answer is yes. Okay, we can. Yes, if it meets the criteria. So what is the criteria? If you borrow money solely for the building of your asset, okay, not for other purpose. If you borrow some money for your personal use, but you want to add that amount of interest with the asset that you are building, you cannot do that. Okay, so now let's solve this problem. This one is the problem. On January 1, 2018, the company began constructions of an office building. See that? To be used as its corporate headquarters. The building was completed early in 2019. Okay, meaning they took 2 years. Construction expenditures for 2018, which were incurred. See that this is the very important point. Evenly throughout the year. Total 6 million. So the company had debt obligations which were outstanding during 2018. See, construction loan, long-term note, long-term note. Okay, they are long-term notes. Okay, we need to be careful about those. And this is the construction loan, 10% for 2018. So let's see answer. So first one, what we do. The first one, oh, this is for 2018. Okay, first one. Average accumulated expenditure. How? Let's see. The average accumulated expenditure would be, see that we have spent total 6 million for 2 years, okay? 18 and 19. So for 2018, it's gonna be 3 million, okay? 3 million average accumulated expenditure for 2018. That's fine. And now, interest capitalized, it should be. So the first one is, say that, 3 million, but from this 3 million, see, we are subtracting this 1.5 million construction loan, 1.5 million, 1.5 million. So, and the rate of interest is 10%. Okay, so and multiplied by 10%, and it's gonna be equal to 150,000. Okay, and we have the remaining amount. So what is the remaining amount? The remaining amount is 1.5 billion again. And now this is our construction loan, that is short term, but see the long term note, we have 9 million, 9% and 6%, and they are 2 million and 4 million. So we need to calculate the weighted average. So weighted average, so weighted average rate of interest on other date, and it should be, so okay, on 2 million 9%, and that is equal to 180,000, and on 4 million the rate is 6%. Okay, and the amount is 240. So the total interest, so let's see this. Okay, so our total capital, meaning total debt, is 6 million, and here the total interest is 420 million. Sorry, 420,000. Can you see that? So the interest rate. So interest rate is gonna be, interest rate would be 420. So 420,000 divided by 6 million, and which is equal to 7%. Okay. So now here, now come here. So the interest. So see that 1.5 billion was our short-term loan, and this is our long-term loan total. Okay, we have spent from this 6 million. So, and the weighted average interest rate is 7%. So 7%. So it's gonna be 7% of 1.5 billion. So 105,000. So interest to be capitalized is how much? 255,000. You got it? A little bit calculative, but not difficult. Okay. So the most interesting problem for today is this one. Okay. Let's see what it is. In our past problem, what we have done, see, in this problem, we have said that the expenses incurred evenly throughout the year, okay, evenly throughout the year. But most of the cases, your expenses may not be evenly distributed throughout the years, okay? Okay, this problem is the same kind. Okay, let's see. On January 1, 2018, the company began construction on a new manufacturing facility for its own use. The building was completed in 2019. The only interesting, actually, it should not be interesting, only interest bearing, okay? Only interest bearing. Okay, interest bearing debt the company has outstanding during 2018 was long-term bonds, okay, with a book value of 10 million and effective interest rate of 8%. So the construction expenditures were incurred during 2018 were as follows. Okay, calculate the amount of interest to be capitalized for 2018. Okay, this is a very interesting problem. Let's see this one. So see that first one, we have spent, we started this amount say January 1st, so we spent for 12 months. March 1st, so January, February out, so only for 10 months. So what I am doing, I'm writing this 12 months, okay? And this one is for 10 months, correct? And this one, July 1st. So July, August, September, October. So 6 months, correct? This one is for, no? Oh, July 31st. So it should be started from August, September, October, November, December. So it should be for 5 months. And how about this one? This one, we started on September 30. So October, November, December. So 3 months. And this one, 0 months, because we started on December 31st, 2018. So we spent nothing from here. So what we do, the first one, average accumulated expenditure 2018. Okay, let's see. Average accumulated expenditure. It is better to have a table. January 1st, 2018. We started this one on January 1st, 2018. Okay. And the amount is 500,000. Okay. And 500,000 in multiple sign. Okay. So 12 over 12. Okay. Because see, this is 12 months we spent for. Okay. And this is an equal to, and this is our amount. Okay. Now let's see. March 1st. Okay. 2018 we started. And the amount is 600,000. So and see, this is 10 over 12 because we spent this one for 10 months from starting from March 1st, and should be equal to how much? 500,000. Because see, you would divide this one by 12 and multiply by 10. Then July 31st, 2018, and we spent 480. Okay, multiplied by, so 5 over 12 equal to, so equal to, and then September 30, 2018, the amount is 600,000. Okay, and we spent this one for 3 months, so the equivalent amount is 150,000. And how about the amount we started on December 31st, 2018? Okay, and this is 300,000. Okay, multiplied by 0 over 12. Can you see that? Meaning we spent only 0 days. Okay, so this one is 0. Our total amount. This is underlined. Total amount is going to be, so it should be underlined. Okay. Total amount would be 1,350,000. Okay. So it's very simple. So there is nothing else, only one kind of debt. So 8% effective interest rate. So amount of interest to be capitalized equal to 1,350,000 multiplied by 8%, and which is equal to 108,000. Okay, this is the answer. There you go. Okay, and what else? Okay, I have something else to share with you, and that is okay, asset donation. And sometimes we acquire assets by issuing securities. Okay, see that we have actually issued common stock and we acquired land. Okay, so this is the acquisition of land by issuing common stock. See, the company issued 10,000 shares of its no par common stock in exchange for land on the date of the transaction, and the fair value of the common stock evidenced by its market price was 20 per share. So that is why it is 200,000. So land debit and common stock credit. And sometimes we receive some assets by donation. Okay, so what should we do? Revenue is credited for the donation amount. Revenue is credited for the amount of the donation. Okay, so and let's see one example. This is one example. See, the Elkhorn Enterprises decided to relocate its office headquarters to the city of Westmont. The city agreed to pay 20% of the 20 million cost of the building um, in order to Elkhorn, entice Elkhorn so that they come to relocate. So the building was completed on May 3rd, 2018. The Elkhorn paid its portion of the cost of the building in cash. So see that how we will be recording this one. So this is the 20 million, and meaning this is the building they have. Okay, and see, this is the amount of donation we received because the city said we will pay 20% of the building. Okay, so this is our revenue. So the difference between these two is the amount that we actually paid. See that? So this is the revenue. We are saying revenue donation of an asset. Okay, and this is the cash. The difference between these two, the donation and the cost of the building. Okay, this is the actual cash we paid. So just have that in mind that this is how we record the donation. So can you solve this one? Kanil, Karnil, just a minute. It should take 1 minute or 2 minutes only. Access for 50,000 shares of companies no per common stock that day the common stock had a fair value of 22 per share that determine the cost of the patent. Oh, it's very simple. Just multiply.
It's D.
D,
D.
D, yes. It's D. Very simple. Yeah. So there are some differences between generally accepted accounting principles and international financial reporting standard in case of government grants. So both US GAAP and IFRS require that donated assets be valued at their fair values. That both of them, they are saying on this ground that okay, and recorded as revenue in the period received. Okay, as revenue in the period received. We have seen that in the previous journal. And subtract the amount of the grant in determining the initial cost of the asset. Okay, this is in IFRS, and or record the grant as a liability, deferred income in the balance sheet, and recognize it in the income statement systematically over the asset's useful life. Okay, so just this one is a little bit different, so be careful about this one. Okay, and this one I have in mind, fixed asset turnover ratio. How do we calculate this one? That's just a formula. This is simply a formula: net sales over average fixed assets. Okay, net sales over average fixed assets. Average fixed assets means, say that fixed assets of year 1 plus fixed asset of year 2 divided by 2. This is the average one. Okay, or you can say beginning fixed assets plus ending and divided by 2. This is the average one. Okay, so this is an example. We have property, plant and equipment net 15 16 for GAAP and for Ross stores, and net sales this one. And let's see the fixed asset turnover ratio. This is for GAAP. See, how do we calculate this one? This is the average asset. Okay, so net sales divided by the average asset. So this is the fixed asset turnover ratio. And for the ROS. Okay, so this one we have. This one, exchanges. So it refers to the acquisition of an asset in exchange for an asset other than cash. Very simple. So old asset, you will give the old asset. Let's think about if you want to buy an iPhone 12 now, Ranil, there is a trading, correct? You can trade your iPhone 10 or iPhone 8 for iPhone 12. So that is this is actually exchange. It's the trading. This is also called trade in. Okay, so you can give the old asset. This is the trading, and you receive the new one. It's very simple. The new asset is acquired, and the difference you will pay. Correct. So if your iPhone, say, if you have an iPhone 8, and they want to say the fair value is $100, okay, and the iPhone 12, the cost is, say, for example, it is 1,000, okay. So the trading, the difference between these two is 900, okay. So you will pay 900, okay. This is. And here is an example. The Elcon company traded. Okay, this is the last one. We'll stop after this one. Okay, it's laser equipment for the newer air-cooled ion laser manufactured by American Laser Corporation. The old equipment had a book value of 100,000. Cost of 500,000 less accumulated depreciation of 400,000 and fair value of 150,000 to equalize the fair value of the assets exchanged. In addition to the old equipment, Elcon applied, okay, paid American Laser 430,000 in cash. Okay, and let's see how it works. So the accumulated depreciation, old one. Okay, we have, this is the old one. Okay, debit. First accumulated depreciation debit. This is the one. And equipment, old one. Okay, this is the 500,000. This is the cost of the equipment, the old one. And the cash actually we paid 430,000. Okay, and the difference is the equipment new. Fair value of the new equipment is this. See now how it works. Okay, so today is after this. So have a good one. Have you already started the